Good morning, everyone. This is Barry Knapp with Ironside's Macroeconomics. It's Monday, June 14th. Our note this week was titled Borrow Now or Borrow Later. It was released on Saturday morning, the 12th. Before I get started with this week's podcast and video produced by Nucleus 195, one quick note: if you didn't catch Paul Tudor Jones's half-an-hour interview with Andrew Ross Sorkin this morning on CNBC, I'd suggest go looking at some clips. We have nothing but respect for Paul Tudor Jones. He was a client back in my equity derivative days at Lehman Brothers and just a brilliant investor. They also have a conference coming up, a Robinhood Foundation conference, and was a charity of my wife and I for quite a long time. Looks like a fascinating conference, getting to hear Stan Druckenmiller interview Kevin Warsh, and Paul Tudor Jones interviewed David Tepper, also a former client. Sounds like it would be worth the price of admission for sure. So that's it on that. There were three sections to our note this week. The first one was titled A Reflation Rinsing and the Rates Market. And we'll go through describing that ferocious rally in Treasury prices last week, the sharp decline in front-end break-evens prior to the CPI report on Thursday. The second section of the note was fiscal scenarios and Treasury seasonality. This is directly related to the first section of the note, under the idea that if you don't know where you've been, you can't know where you're going. And so we're going to do a little bit of both in these first two sections. And then the final section is a little bit more of an optimistic note on labor dynamism, optimistic in the sense that this is how we think we go from a disinflationary environment to a reflationary environment, not straight to an inflationary environment, and some things that are happening in the labor market that could boost real wage growth and prevent us from running into larger inflationary problems, as many are suggesting are right around the corner. So first on the rates rinsing, if you will, we think a lot of the reason that the market got squeezed as badly as it did last week was because people misdiagnosed the reason for the first quarter impulsive move higher in rates. Our regular readers and listeners know that we believe that the real catalyst, the change, the surprise to the market was the blue wave in early January and the subsequent $1.9 trillion fiscal spending bill that the market had to reprice, particularly in the very long end. And so if you believe that it was inflation that pushed rates, was the primary catalyst for pushing rates higher, you could be thrown off and look at what happened last week as discounting the peak in inflation, which from the components that are somewhat transitory, things like used car prices, we probably are into the peak of the reopening related disruption, but we think there's a much longer trend at hand here. And as we said, the real catalyst for the move higher was, what's the fiscal impulse? So that brings us to really just diagnosing this 2 to 10 year sharp decline in inflation break-evens. That's the difference between nominal inflation yields and the TIPS yields. So we would say there was probably four main factors that people were pointing to, none of which we think is particularly valid. The first one was the loss of fiscal momentum of the Biden administration. And that's the point, the very title of our note is Borrow Now or Borrow Later. We don't believe that some of the issues that have been raised, which we'll come back to in a minute, are going to prevent them from doing at least or borrowing another $1 to $2 trillion in deficit finance. The second is this idea that we reached the peak in CPI or any of the other inflation aggregates, core PCED. Even if we haven't reached the peak, there's this idea that, well, the Fed will respond vigorously. And then finally, some have cited the Fed RRP program, which is up to some $500 billion or so now, as a draining of liquidity from the system. And so just going through those one by one, We do not believe that the Biden administration's agenda is done and dusted. They are still going to do some serious transfers and expansion of the welfare state. They'll get to that a little bit later in the summer. As far as the CPI peak goes, we would agree that this will be the peak for some of these transitory factors like used car prices or now new car prices starting to move. However, the era of importing disinflation from China, we think, is largely over, and that will be the persistent effect that will move us into a much higher inflation regime over time, but we'll leave the Fed in a position where we will not have a 1.5% core PCED persisting through the business cycle like we did last cycle. And the Fed is not going to be able to respond as vigorously. As Bill Martin used to say, the Fed is independent within the government, not of the government, and they're going to have to finance all of the debt and deficits that Congress has voted in. And finally, the RRP program is just not really draining liquidity in the system. That money was just sitting idly in banks, and it just underscores why the QE is as inefficacious as it is, because you've got regulatory and monetary policy working at cross purposes. Not quite as acutely as you did in the aftermath of the global financial crisis, but clearly supplementary leverage ratios, temporary loss adjusted capital ratios, all these various restrictions on bank lending are just causing that money to clog up into the banking system. So moving on, we would note that within last week's CPI report, the dead weight, what we call the dead weight sectors, and excess inflation, that's healthcare inflation, housing-related inflation, and education-related inflation. Really, those were drags on productivity in this country for 4 decades and had excess price increases. Those are actually negatively contributing now. And while we think that those are going to improve in part because of technology innovation adoption in the next decade or so, they're negatively contributing right now. So they are going to go back to their old position of contributing to inflation, strongly to inflation. And so thinking that this whole thing is transitory, it's just going to disappear in the second half of the year is pretty incongruous. And one quick note on jobless claims last week, it does look like a downtrend is starting to form in continuing claims. That could be very good news, may mean that the June employment report will show the labor market bottlenecks starting to clear somewhat. So next section of the note was on fiscal scenarios and seasonality. We walked through what happened with the Senate Parliamentarian, the ruling that you needed to have a majority in the Senate Budget Committee to get a adjustment or addendum to last year's budget through the whole of the Senate. With the Budget Committee split 50-50, you can't do that. So that effectively means that the Biden administration and Democratic Party has one more bite at the reconciliation apple, so to speak, this year. And that implies that they're going to combine the jobs plan and the family plan. Even if they do cut a deal with the Republicans for infrastructure, they'll combine that other stuff and put it through. They probably will file the budget resolution in August. The House will vote on it in September, Senate shortly thereafter. They'll merge the bills sometime around October, November. The market will start to price it when it becomes obvious that's what they're going to do sometime after Labor Day. And that could coincide with the taper tantrum and mean that or the Fed starting to taper asset purchases and mean that we have a pretty toxic mix of fiscal and monetary policy pushing on the back end of the rates market simultaneously, which brings me to the seasonality question. Each of the last 5 years, we've had major lows in the rates market in 10-year yields, sometime either early or late summer. So 2016, Brexit caused a ferocious rally in Treasury prices. Yields went down sharply. There was a early July low in 10-year yields, and they went up 100 basis points after that. In 2017, it was the Trump agenda stalling, and then you had an early September low in rates, a 40 basis point rally in those rates in the fall. 2018, it was quantitative tightening. We had a 40 basis, again, a low in early September, a 40 basis point move in 10-year yields. 2019, it was the trade war, again, an early September low, a 50 basis point move higher in 10-year yields. And then in 2020, the pandemic low was in early August and a 40 basis point move from the very low level of 51 basis points through the course of the fall. So there's a pretty persistent pattern here of rates bottoming somewhere around the August timeframe, and then having sharp moves in the fall. We think we're probably set up for something similar this go around. And that's how we would think about where we're headed with rates from this point. It still makes sense to buy cheap hedges on the rates market. Nevertheless, we'll probably make a low a little bit later this summer when the Biden administration starts to regain momentum. And then finally, moving on to labor dynamism, there's some distinct differences between the aftermath of the global financial crisis and the pandemic. The global financial crisis trapped people in their homes and, because of negative equity, severely limited the mobility of the workforce. People couldn't, as the economy restructured somewhat after the global financial crisis, people couldn't easily move and go pursue those jobs. The pandemic has had the opposite effect. We cited a study a couple of times now from one of our favorite economists, Stephen Davis, and a couple of other notable economic economists, that the number of work days that will be done from home pre-pandemic was 5%. Post-pandemic, they believe, their study concluded, would be more like 20%. That is a major shock and increase in mobility of the workforce. This whole idea of labor force dynamism, worker reallocation, is a driver of real wage growth. It's a driver of productivity, people doing jobs they really want to do, the labor force being more flexible and dynamic. We cited the original paper on worker reallocation. The way we measure it, and they did in this paper as well, is to take the quarterly sum of hirings and separations. Quits are going up quite a bit to their highest levels ever, underscoring how workers just have that much more flexibility. There was a really big inflection point last cycle in 2014 after the end of extended unemployment benefits, when job openings went up, quits went up, dynamism jumped by some 2% or so. It's roughly 25% of the labor force that turns over every 3 months. Seems like a fantastically high number, but that is indeed the case. It's driven by several industries like construction, leisure and hospitality, retail. These were the sectors most impacted by the pandemic. It was part of the reason for our optimism early on in the cycle. But nonetheless, increases in worker reallocation in the middle of last cycle led to much stronger real wage growth later in the cycle. You could see that chart if you watch the video or subscribe to our full notes. You'll get all the background around all of this. And it is possible that we will have labor productivity, capital deepening. We've made our arguments for stronger capital spending, and total factor productivity, which is innovation adoption, all going on simultaneously in the coming years of this cycle. That could act as a real pushback against a big inflationary impulse, certainly the policy inflationary impulse, and prevent us from getting into an inflationary spiral as soon as some prognosticators believe. So that to us is a really key issue and worth watching. And we will continue to measure it. Part of our reason for coming to this is after the JOLTS report last week, we had incredible increases in reallocation in the pandemic, but it's starting to settle into a pattern that looks like it's above where it was prior to the pandemic, and looks like it's starting to trend higher. So that's all really good news. And as I said, a big offset to the inflation outlook. So that's it for me this week. If there's something interesting to say about the Fed, I'll put out a brief podcast for paid subscribers. And otherwise, you can look for our note later this week. I should get the client presentation out to paid subscribers as well. Yet another reason why you should be a full subscriber to Ironside's Macros Research. So Barry Knapp, have a good week, everyone. Thank you.